I want to pull up the Tata Motors stock, and Tata Motors seeing pain specifically because of what JLR has put up 4.5% down nearly on Tata Motors. JLR has shocked investors because it's cut its FY26 EBIT margin guidance from 5 to 7%, down from 10% earlier. What are they saying? Hiral is joining us for more.
Thank you, Tamanna, for that. So, in fact, Tata Motors is now the top loser in terms of Nifty 50. EBIT margin guidance, that has been reduced to 5 to 7% for FY26 versus the earlier guidance of 10%, and that's the key highlight. Because of the guidance reduction is what the stock is reacting to. In terms of the free cash flow as well, that is close to almost zero in terms of FY26, and they're expecting improvement on a year-on-year basis only from FY27 and 28 onwards. Apart from that, if you talk about their China premium market, that is what has been facing pressure, and this is what they've given data in terms of calendar year 24. 215 models across companies have seen a price reduction, so there is pricing pressure that is coming in terms of the Chinese market. Apart from that, 4,400 retailers have gone down in the PV segment, and the premium market has seen a degrowth of around 15%. So overall, China, which is one of the major markets for JLR, has been under pressure. Overall, another segment that they are looking to enter is the Freelander, but that will come in only in the second half of FY26. So there is a wait and watch mode on that front as well. Though FY25 for Tata Motors was a breaking year because they did deliver the best ever EBIT since FY15. Record profit number in terms of FY25, the best ever dividend, and in terms of Defenders, they sold a record number of 115,000 units. So in spite of FY25 being really strong, China is the one which is going to put pressure from here on as well. And the kind of downtick that they're expecting in terms of the EBIT is going to be a concern at least for the next 1 year. 27 and 28 is what we need to wait and watch and see.
Okay, thank you for that, Hiral. So now, while it's a down day for Tata Motors, chemicals are buzzing because of this Morgan Stanley note on chemicals, and a whole host of them have been upgraded. I want to start by it one by one. PI Industries has been upgraded to an overweight from an equal weight. The target price, sharp target price, hiked to 5,000 rupees from 3,524. Big up move there. Navin Fluorine upgraded to equal weight from underweight, hiked the target price from 3242 to 4160. For SRF, they've maintained an underweight and hiked the target price from 2150 to 2150 from 1870. For Aarti Industries, maintained an underweight and target price is hiked to 385 from 360. For Tata Chemicals, maintained an underweight, hiked the target price to 839 from 780. Now, the reasons I found very interesting as well, Nirajan, why Morgan Stanley is constructive on chemicals.
Yeah, I mean, well, the reasons, of course, will be multifold. They expect a more constructive, volume-led agrochemical cycle in 2026. They believe that will support stronger asset runs and operating leverage-led margin tailwinds against twin challenges of shaky demand and weak pricing that have shaped up FY25. And of course, as will be the case with most sectors, if not all, valuations keeps Morgan Stanley selective. So, well, that's their view on some of the chemical names.